Hello, thank you for joining us. I'm Sal Martone from Treasury Partners. I'm here with Dan Beniak. We're here for another monthly fixed income recap. Dan, fixed income's been volatile over the last couple of months, but particularly in the last month, we had Powell at Jackson Hole that was preparing the markets for at least a 25 basis point rate cut later this year. He acknowledged inflation is higher than it has been in the past, but he thinks it'll be a one time and it'll head down. Is that what you're seeing, Dan?
It's actually some interesting trends that we're starting to see in the fixed income markets in recent weeks, Sal, after a relatively tame August. People are back from their summer breaks and focused again. We're actually seeing some divergence on the curve. So on the front end of the curve, for instance, 2-year treasuries, which are going to absolutely be responsive to investor expectations for what the Fed's about to do, that has seen a significant decline. A couple months ago, we saw the 2-year treasury trading around 4%. Now it's around 3.5% because Fed cuts are now baked into the cake. 125 basis point cut next week, at least two more before the end of the year, and that's causing short-term rates to head down. The entire curve is rallying. Let's be straight about this, but we're not seeing the rally extend to the same extent on the long end of the curve, Sal. So longer term maturities like the 10-year and the 30-year Treasury, they've rallied not 50 basis points, more like 25 basis points over the same time frame. So the 10-year Treasury is closer to 4% now. The 30-year Treasury, which had been touching 5% a couple months ago, is now more 475 area. Still a rally, but that's because the long end of the curve responds to different forces and dynamics than just the front end of the curve's focus on Fed actions. That does pertain to what happens to rates on the long end, but you also have investors a little worried about inflation, which is no longer in the 2% area. It's printing closer to 3% area. So that's a risk that longer term investors have to consider. Additionally, investors are getting a little more skittish about the strength of the economy. We're still growing, job growth is still positive, but it's definitely slowing. And when you extend maturities, you have your principal tied up for longer. More can go wrong until the point where you get your money back. So that investors want additional compensation to offset those concerns. Another consideration that has absolutely been a factor throughout this whole year is the fact that new issue has been trending significantly higher than normal in basically every market in fixed income, right? The US Treasury, the US government has a significant deficit. That means Treasury issuance has been high. Investment grade corporate issuance has been high. US municipal bond issuance has been high. Bonds need to be placed when they're created. They're getting placed with investors. The deals are getting done. But in order to accommodate that surge in supply, investors just want extra compensation. They've been getting it. In practice, what this means is no change in terms of our strategy. We still feel that you investors are getting relatively fair and attractive compensation for extending maturities. So we've kept doing that. Despite the rally, U.S. muni yields are on the long end, they're off their recent highs, but we're still able to find some at 4.5% plus, tax-free in some cases. In investment grade credit, 7 to 10 year high grade maturities are anywhere from 4.25 to 4.5% plus, also pretty good yield in our book. So we're sticking to our knitting there, Sal.
Great. Thanks.
Thank you.